Hi guys, Scott Harris here from Green & Co Accountants. Just wanted to run through a few things that appeared in the budget earlier this week and how they affect people in the property sector. Okay, so as expected, the stamp duty land tax holiday is being extended in England until the 30th of June. After that time, it'll reduce down to £250,000 up until the 30th of September. And then from the 1st of October onwards, it'll revert back to the original rate of £125,000. In Wales, however, the increased nil rate band for land transaction tax will stay in force until the 30th of June, which is currently at £250,000. But from the 1st of July onwards, it will revert back to the original rate of £180,000. 95% mortgages are set to return to the market from next month, and the scheme will run up until December 2022. A lot less restrictions this time round. It's not restricted to just first-time buyers or new build homes, and it's for property prices up to £600,000. So it's obviously a good news for the property market, property developers in particular, as inevitably is going to push up demand in the market and possibly improve profits. There's been no change around the CGT, IHT or the pension lifetime allowances. Now, firstly, this doesn't seem like a bad thing, but if you were to look to realise your investments further on down the road and these allowances are not increasing in line with any price indexes and naturally property prices increase, it could mean a heftier tax bill when you come to realise your investments, so not so much of a good thing. There were rumours around increasing CGT rates in line with income tax rates. Fortunately, we didn't see anything in this budget. However, it's still one to watch. Corporation tax is set to increase from April 2023. Now, this is probably the highlight of the budget. It's the one that people are most speaking of. Understandably, from the property sector, where most people have started to incorporate their portfolios, landlords and investors are probably going to start worrying whether or not it's still tax efficient to hold property in a limited company. However, I've decided to break this down in a graphical form just to illustrate the changes that are coming into force in April 2023. Okay, so this is a graph showing the taxable profits against the effective rate of tax. Now, for the purposes of this exercise, I've assumed that all the distributable profits will be drawn from the company via dividends payable at the basic rate being 7.5%. The blue bars signify profit and start from 50k all the way up to 250k, and the orange line signifies the effective rate of tax. Just want to point your attention out here to the 50k profit line. As you can see, the effective rate of tax is 25%. This is where we are currently at now before the changes come into force. Anything above this line illustrates the effect of the changes coming in post-April 2023. So we're expecting that by the time your profit levels get to 250k and above, that the effective rate of tax will be 30.6%. Now, that at that level, it will plateau for any profits exceeding 250k also. I also wanted to point your attention out to the 100k profit line here, with the effective rate of tax being fairly high still, being 28.5%. Notice that the curve of the effective tax rate between the 50k and the 100k profit levels is steeper. Now, this means that as your profits increase within this range, you will feel that you're getting taxed disproportionately more than the increase in profit levels exceeding 100k. However, it's important to note that the effective rate of tax wouldn't exceed 30.6% if you're trying to remain below the higher rate band personally. Hopefully that helped with understanding the changes of corporation tax coming in soon. But the question of whether or not it's still tax efficient to hold property in a limited company is still one to be debated based on your personal circumstances, as it's not a one-size-fits-all situation. So if you still have those queries based on this information, it's probably best that you seek advice from a specialist property tax advisor. The personal allowance will also be increasing to £12,570 from April, as will the higher rate tax band will be increasing to £50,270. Both of these will be frozen up until April 2026. So although again seems like decent news, as wages increase over time, it's likely that because these bans are frozen, we will start paying more income tax down the road. In addition to that, the primary threshold for national insurance, class 1, is also increasing very marginally to £9,568 instead from April. So it's likely that your director salaries, if you do have them, will change from April. There's a new super deduction coming in from April 2021. It's applicable to only companies, and it's basically a capital allowance for companies investing in plant and machinery. Now, assets that usually go to the general pool will be able to get 130% tax write-off, which is fantastic. It's unprecedented. We haven't had this before. And for assets that are usually entered into the special rate pool, they'll get a 50% first year allowance or tax write-off straight away. This will be really attractive to people who are investing in commercial property or the other trades, such as builders, electricians, and the like. But it could also be useful for other property investors where capital allowances are usually claimable. There's loads of other changes which have appeared in the budget that I haven't mentioned here. So if you have any questions, please don't hesitate to get in touch with me directly or post in the comments below. I hope you enjoyed watching this video. Please give it a like and a share. It'd be much appreciated. Thanks very much for watching. Take care.